Hi, this is Mark Carter with Financial Strategy Group, along with Brice. Um, we wanted to, this is live. We did it live just to make sure that we got this information out to our clients as soon as possible. Um, so excuse us if there's any errors in this, but we want to talk a little bit about what's going on with markets, bring you up to date, have you understand what we're doing at Financial Strategies Group to manage the portfolios, changes that we've already made this year, things that we're doing actively right now to go through what this economy is obviously struggling. And there's some headwinds, some potential tailwinds, and we want to keep you up to date. So I'm going to turn it over to Brice a little bit. We're going to walk through some slides, give you a little picture of what's happening right now in the world.
Yeah, so the way that we kind of set this up is really just to be a conversation,
Yeah.
and that's part of the live thing. Is you get it's very authentic. There's no script to go off of, and so this is a conversation with, I don't like to say slides. It's a conversation with some pictures. So we're going to cue those up, and we're going to just go through some things. So if you remember in 2020 when we were going through the COVID market crash. I did a couple of market write-ups and we did a live presentation at that time.
Similar thing, yes.
And we called it the anatomy of a market crash. And so this is the 2022 version. Not to be funny, but it's
unfortunately
it's the remix. And so we're just going to go through a couple of slides here. So what you'll see is this. I love this chart. This is the investor cycle of emotions. And so it starts out when markets are going up, you feel a lot of optimism, excitement, thrill, and euphoria. And really, markets are at the riskiest when everyone's feeling a sense of euphoria.
Right.
And so I think we were kind of starting to get to that point throughout the period, throughout times last year. So 2019 was a fantastic market year. 2020, despite COVID, there was it finished really strong. And 2021 was a great market year. And not only that, we started to see investors in different categories start to buy into really kind of silly things, meme stocks, and chasing these pie in the sky kind of investments, as opposed to looking at what companies should be valued at.
You know what? I think we should put a big headline on this chart. I like it as well. That says emotion is your enemy when it comes to investing.
It is.
It's really as simple as that. If you let your emotion take hold in markets like this, mistakes are made, and mistakes are very difficult to recover. And that's obviously one of the reasons you have us, is to prevent that emotion from taking place. Not that this doesn't bother us. Nobody likes this.
Yeah. And really, I mean, I look at this chart and I think on the anxiety, denial, fear, panic situation, I don't feel that when it comes to markets, but sometimes I feel that about getting concerned of how people are going to respond. I'm not scared of markets. I'm scared people are going to make a bad decision.
That you're absolutely correct. And part of that is because we do this for a living.
Yes.
And so therefore we've managed through these things, whether it's 2008, 2009, in past market corrections, market volatility. And it's not that we're not concerned. We are concerned, but emotionally, we believe that we're going to manage through this, and ultimately our clients are going to come out just fine and on top when it's all said and done.
Right. So what has happened, and then why? So what has happened is you'll see here the three indexes, or ETFs representing indexes. We have bonds in the red there at 10.4% down for the year. S&P 500 in green at 13.13% down for the year. This is closed Friday. And the NASDAQ down 22%. And I'd like to make a point that the NASDAQ is really growth and technology companies, something we've been talking about for a while, that are probably overpriced. And that's where the worst selling has been.
Yeah, and they have been overpriced. And I think the big key to understand here, obviously, is what has happened with bonds. Unlike what occurred in March of 2020 when the pandemic first broke out, you ended up with stocks falling dramatically and getting a nice big spike, and especially in U.S. Treasuries in that month of March. And we'll talk a little bit more about what's happening with the bond market, but that's not happening right now.
Traditionally, bonds are a nice. I like to say they're an anchor for a sailboat when it's a little too choppy, and they haven't been this year for stocks. And there's a very specific reason for that. And it's also a reason we've kind of been a little bit underweight bonds for some time now. So context matters, right? So over the last 5 years, this is returns ending December 31st, 5-year return on the S&P 500, 18% a year, and bonds 3.5% a year. So bonds have not been by any means a phenomenal rate of return, but very stable, as you can see from that line.
Right.
And then equities have had a heck of a run.
Right.
So to say that we're down, that S&P is down 13, 14, 15% this year, it's up 132% over the last 5 years.
Yeah, and so we're giving back the earnings with clients that have been with us a long time of what we've been able to participate in market growth over time.
Yes. So we're down, but markets are going to go down from time to time. If we look at this graph, this gray bar right here that you'll see, that's right when the pandemic was happening. And that is a 33% correction in 6 weeks. And it's all but doesn't matter anymore.
It was wiped out in a relatively short period of time back to the black.
So the question of why does the market do what it does? Sometimes we wonder that on the day-to-day basis, which the day-to-day doesn't make a lot of sense when you're looking at markets. It's the longer term that makes sense. And sometimes that can be a quarter, sometimes that can be a year, sometimes that can take several years to unfold.
Absolutely.
But the big things happening right now are inflation. It's at a 40-year high. So if we talk about inflation, it's caused by excess demand from supply. And so obviously we have some supply chain issues. Russia and Ukraine war has contributed to those already strained supply
Added
chains.
to it, yes.
Yes. China's got a zero COVID policy and has shut down and many factories in many cities right now. That's contributing to it. We printed in a tremendous amount of money. In 2020 and 2021, the U.S. government printed more money than the combined history of the world. That is a staggering amount. And so obviously there's a lot of money flowing around. Consumers have been relatively...
but there's not the product, and hence inflation.
And consumers have been relatively healthy. Consumers seem to be spending money and doing things again, and we all deserve to do those things.
Well, that just shows you some of the economic data inside the United States is still strong.
Yes.
It's you're getting these headwinds that are the major components to why markets are down right now.
Yes. So what we're seeing to combat inflation is rising interest rates. So the Fed's raising interest rates. And with rising interest rates, they're trying to slow the economy down. It's almost as if they're trying to either get us right at the precipice of a recession or maybe a gentle recession. It's a tough job that the Fed has to combat inflation.
It is. The concept here of a soft landing and how this is going to play moving forward is really yet to be determined. We don't know that. I don't believe the Feds did a great job of managing the balance sheet, but here we are today. We cannot change the past when it comes to this. But I think defining recession is a big key because people hear the word recession and automatically they're panicked, right? So let's first define recession. Recession is 2 consecutive quarters of negative GDP. And there's a big difference between a depression and a recession, as well as there's different types of recession, right? Recessions can be, again, a relatively soft transition, or they can be harder. And nobody can predict how those are going to play. Just like you cannot predict what Russia, did in Ukraine, what happened or what occurred with a pandemic hitting. And so the key is to, and what we do is manage those things, monitor those things, and manage through them.
Yeah, and I think it's because we just had a negative quarter of GDP.
Yeah.
It's fairly probable that we're in a recession right now because this quarter could be negative.
Yes.
And that by definition would be a recession. And if the market is often crashes before a recession as it's looking forward.
That's a great point.
We could be on the back end of this market recovery by the time a recession is even announced.
Yeah. And so remember that markets are always working ahead. So it doesn't mean when the second quarter GDP announces and if that happens to be a negative number, the markets are all of a sudden going to go crazy. It just simply means that the definition of recession is hit, but markets are always working ahead. They already realize what the Fed, at least what the Fed said, what they're going to do with interest rates in June and July. They're really priced in a negative GDP for the second quarter. And some of these things that you're thinking when they hit, it's too late. Markets are already working in that cycle. It's the unexpected things that occur and happen is really have the biggest negative impact.
Right. So I want to zero in on that last bullet point, the rising interest rates. So this is the 10-year treasury rate. And basically what you see is coming into the pandemic in 2020, rates were decent. They're around 2%.
Yep.
And then the Fed started cutting interest rates and everybody was pouring into treasuries. They went down, the rate went down substantially. And is now, since the pandemic, treasury rate has gone up by 102%. Now the rate's not 102%.
Right.
It's above 3%, but it's gone up substantially. And so when you see rising interest rates, bonds move in the opposite direction of interest rates. So as interest rates rise, bonds go down, which is why we're not getting that relief from bonds that we usually do during a market crash.
It's also why we did anticipate this to a certain extent. You can't anticipate it completely, but we did reduce our fixed bond holdings in 2021.
Yeah, we bought gold, which has been just about the only place to hide this year, unless you own oil wells. And so gold's up about 3% again as of close Friday. And so gold's up a couple percentage points. Those are not going to offset completely a 12% downturn in the S&P, but it certainly has helped.
So again, know that the portfolios that we're managing really through the spectrum have a gold position in them, and that was put in 2021 with a little bit of anticipation of this. But the position is somewhere between 3 and 5%, depending on your risk tolerance. So when we say our portfolios are holding gold, it's important to understand that diversification is the key as well. So the gold positions that we're holding are not huge 25 or 30 positions. It is somewhere between 3 and 5%, depending on the risk tolerance that our clients are in.
Right. I mean, we believe in managing portfolios strategically, which means you don't just buy one thing and forget about it. Although that strategy can work if you can ride through the massive waves, it's about holding a diversified portfolio and making on-ramps and off-ramps with that portfolio over time by several percentage points to decrease risk and potentially improve returns.
Well, and that's also why we're very confident we're going to be able to manage through this, is because we don't have our clients so loaded up in one particular asset class that the effect is so dramatic that it takes such an extended period of time to recover.
Right. The goal is not to hit homers and grand slams. It's to make base hits.
Yes.
And when you swing for the fences, that's when you strike out. And so we make base hits. So I like this chart a lot too. This shows the length of bull markets versus the length of bear markets. So a bull market is an up market, right? That's an uptrend.
Yep.
And a bear market, as we discussed, or maybe we didn't today, but we probably should. A crash is a bear market. That's a 20% downturn. Okay. We're not there yet with the S&P 500. The NASDAQ is in a crash phase. So a bear market is a 20% downturn. A correction is only 10%. So we're in the correction territory right now. But this shows the length in blue of bull markets from 1942 until last year, and until the start of this year, and bear markets down in the orange. And when you look at it in this context, you see how little of an impact
absolutely
those bear markets have really had on long-term investors. And I would like to note that each one of those gray bars that goes from top to bottom there, those are recessions. So recessions are quite common. I mean, we did have a short one in 2020. We obviously had a long and painful one in 2008, 2009.
Yes.
We had one in 1999, 2001 in that period. And so there's been a lot of recessions that are not depressions. And so I think it's important to keep that in context. And when we look at that, patience is the key.
Well, it is. Just look at the chart and understand that markets have a cycle. Right. And unfortunately, on the down cycle, nobody likes it, but on the up cycle, everybody loves it. Right. But to end up at the top, you have to sometimes take a step backwards to move forward. And ultimately, that's the way you want to visualize markets.
Right. And so this is my favorite quote, investing quote of all time. It's
Love
from
it.
the lovely Warren Buffett, out of who's the CEO of Berkshire Hathaway, infamous investor out of Omaha, Nebraska, who owns a Dairy Queen and Coca-Cola, and he loves
Everything
to
else he
yeah,
wants,
yeah.
right?
Yeah. So Warren Buffett says the stock market is a device for transferring money from the impatient to the patient.
That's
and
right.
I think that reads absolutely true.
Do you really think that professional money managers are panicking right now? That people that believe in the market and the market exposure are panicking right now? No, they're not. They're basically looking for the impatient, the emotional people to sell so they can buy things cheaper.
Yeah.
And when you look at this, understand there's no other way to put this. Emotion is your enemy when it comes to investing. In life as well. You just think about any decisions you make. If you make it based on emotion, it's probably a bad decision. You have to make it based on logic. That's part of the reason you have us here, is to review things, monitor things, and adjust things.
Yeah. Now, I'd like to point out on this slide, I apologize if it's not as legible as we'd like. That's the problem with doing things live and quickly. This is a graph of market growth from 1970 until this year. And every one of those written items is a world event that would have given you pause, perhaps, to invest. So there is all kinds of different things on here. You have presidential elections, you have COVID cases, you have recessions, several recessions,
Wars, different pieces.
wars, oil embargoes, U.S. invading Iraq, Saddam Hussein being elected president. There is an endless number of reasons on here to look at it and say it's not a good time to invest, or I don't want to be
Right.
participating
Or
right
this
now.
time is different.
Right.
Every one of those events, every one of those words that you're looking at, somebody out there in the investment world said this time is different. It's gonna be everlasting, or the doomsday of all. And in reality, what happens in those particular cases is the world is hardly ever in perfect harmony.
Yeah. And yeah, that's the ironic thing with this, is it starts while Vietnam is going on.
Right.
And just a few years later, the fall of Saigon in here, and then you have the Cold War, and then it just one thing after another. There's
right.
always something. And so I think the thing that we want to leave people with today is that we're here. We're
absolutely
proactively managing accounts. We're proactively working for you. If you have questions, if you have concerns, feel free to reach out. That's what, and we do this so that way we can reach a lot more people like this a lot quicker. And so we do these. We want you to know that we're here. And if you have something come up, reach out.
Absolutely. I mean, you're correct. When we do this so that we can reach the masses, right? So we can get this information out as soon as possible. That doesn't mean that we always want to provide that personal touch where you can pick up the phone and call. Obviously, at this given point, myself, Brice, and all the advisors at the Financial Strategies Group and the support team around us are extremely busy analyzing things, taking calls, meeting clients to make sure that everything we can do is being done in your portfolios. And we know that you're going to be successful in the long run. And we view this as a awful time, but it doesn't mean it's going to be awful when the whole thing is said and done, right? Remember, emotion is your enemy, and Financial Strategies want to thank you for your business and your support. And don't hesitate to give us a call if you need anything.
Thank you.
Thank you.